It's good to see you. Thank you guys so much for inviting me on this special day. Wilf, it's been an honor to work with you. I've had a lot of fun. I've learned a lot. We've talked a lot about the banks, especially. So I think I need Josh's tissues before the end of this segment. But thank you for everything. In terms of the market, thanks. Now, a segue into the markets. I don't think we're out of the woods, Sarah. It's a choppy market. We're in a trading range. Volatility is higher. We have to digest a lot of things. And one is inflation, and the other is the Fed. Those are the two big things. And we know the Fed is behind the curve, right? And it's not just by looking at the CPI headline and the PPI headline, but it's inflation that is broadening into rents and into wages and services. I mean, that PPI number was so strong yesterday, in services inflation of 7.8%. So they're behind the curve. Do they do four hikes, 7 hikes, 10 hikes? Nobody knows. The question is, does the Fed want to get back to neutral policy, or do they want to be restrictive policy? And they don't even know, probably, because they're going to have to be data dependent. We get another jobs report before they meet. We get another inflation report before they meet. So there's a lot up in the air, and that's why I think the markets are all over the place. The one thing I think that is underappreciated is the fact that the economic data is actually pretty good in January so far in February, right, in terms of retail sales, industrial production. Auto sales are up 20% month over month. So, and by the way, we just heard from a whole bunch of reopened names like Expedia, like Marriott, like Hilton, even Wynn. A lot of Wynn was good today. And so I think I was expecting a really sluggish first quarter because of Omicron, and we're actually not going to get it. So we have high inflation, but we also have some pretty good growth. The Fed should be moving and acting accordingly.
So, Steph, with all of that in mind, should the banks be doing better than they've done over the last month or so, even if they did start the year well?
Well, they've done so well, Wilf, right? All of last year, they were a big surprise. And then, of course, year to date, they're one of the market's leaders. So, yeah, I mean, I would expect them to do better, but they kind of trade in fits and starts, right? I mean, they report first quarter or fourth quarter earnings, and they always go down. And then they start buying back their stocks, and people realize that the quarters were actually pretty good and the valuations are cheap. And then they kind of pause for a little bit. But I do think that the financials are where you want to be, diversified, of course. Right? So, you know, Bank of America and Morgan Stanley are two big ones. Wells Fargo, we've talked about over the years as well. I still like. But I got to tell you, out of all of these companies, American Express was the one that was absolutely dynamite. And that's the one I would be buying on weakness.